Hello, thank you for tuning in. If you're new to the channel, thank you. Please consider subscribing. And if you're coming back from a previous video, really appreciate your company and thank you for the support. Today, we're talking about some tips on how you can reduce the cost of your insurance cover inside your super. As usual, I have prepared some whiteboard slides to help share my ideas. So let's dive right in and I'll see you at the other end. Here are some tips you might want to consider on how to reduce the cost of your insurance cover. First up, you might want to review your death and TPD cover. The amount of your death and TPD is currently set at a level that may be based on your salary or age or even a fixed amount. Your cover would have been determined based on the overall risk and demographic profile of your employer's plan. It's not tailored to your needs specifically. Therefore, you should consider if your cover is right for you. You may need more or less depending on your financial circumstances. If you're in a good financial position, then you may not need the amount of cover you're insured for. You should be aware though that this can be a tricky approach, particularly if you're not in good health, as you may need satisfactory evidence of good health before the insurer can provide you with the same level of cover you once had. If you're not in good shape health-wise, then special conditions may be applied to your cover if you want to reinstate the same level at a later date. Another option is to review your income protection cover. Some funds offer different waiting period options. The shorter the waiting period, the more expensive your premiums will be. If you have a lot of accrued sick leave, then you might want to consider a longer waiting period to reduce the cost of your insurance cover, because while you are temporarily unable to return to work, your sick leave will tie you over until you satisfy the policy's waiting period. You should be aware that income protection cover is not an unemployment benefit. It will not provide you with a benefit if you've been stood down due to the pandemic disruption. To be eligible for IP benefits, your income loss should be due to an injury or illness. The other consideration is the benefit period. If your fund offers a range of benefit period options, then consider if long-term benefit period is the right one for you. Benefit period to age 65 is typically more expensive than, say, a 2-year benefit period. Be aware, though, that if you choose to have a longer waiting period and a shorter benefit period, reversing this decision at a later date may require underwriting. Another strategy is to promote your health and well-being. Insurers often have a preferred BMI range for insurance purposes, or may consider offering insurance despite the higher risk but subject to a premium loading. If you have previously been underwritten and accepted for cover subject to a premium loading and have invested in a more healthy lifestyle since, then the assumptions made by the insurer at the time may no longer be an accurate representation of your lifestyle today. Why not reach out and provide evidence of your new healthy lifestyle, and the insurer may review your acceptance terms and premium loading. This is a good segue to your habits. Were you a smoker previously? Have you quit smoking in the last 12 months? Some insurers will default members to a category that might have a hybrid assumption that some members of the plan are smokers. Or you might have been a smoker when you were last underwritten for cover years ago. This typically occurs when you are moved to an individual section or a retained section of the plan. If you have quit smoking over 12 months ago, why not reach out to your insurer and ask if they can review your smoking status? You will, of course, have to provide evidence of this. It is no surprise that the cost of cover for non-smokers are cheaper than those who smoke. Another factor that can influence the cost of your insurance is your occupation. Typically, white-collar workers are those who undertake sedentary type of duties and pay cheaper premiums. Again, if the insurer does not know your occupation, then an assumption based on the overall occupation profile of your employer will apply to you. This doesn't help if you work for an employer with a diverse range of occupation, with some that are office-based and others who spend a lot of time on the road. The TPD definition can also vary depending on how high risk your occupation is, but that's a topic for another day. And finally, your working hours. If you have changed employment status, your insurance will almost always be impacted. Less number of working hours will translate to lower income, which may result in lower insurance cover and therefore reduce the cost of your insurance premium. Your employment status may even trigger a change to which category you belong under your fund. For example, if you are a contractor or a casual, your eligibility may be different to that of a permanent full-time employee. Okay, hopefully you learned something from those few slides that we've just watched. Just to recap, some of the things that you could do to reduce the cost of insurance cover inside your super. Check your death and TPD cover, whether it's the appropriate level of cover that's right for you. B, check your income protection cover, whether your benefit period and your waiting period are the appropriate types of design to suit your needs. C, check your health and well-being. If you have adopted a healthier diet and lifestyle, you should definitely let your insurer, through your fund, let them know, just in case they can remove any premium loadings that have been imposed on your cover. The next one is also smoking status. If you have quit smoking in the last 12 months, well done. And perhaps that might translate to cheaper premiums if you are in fact being grouped with a cohort of hybrid of members that have been classified as smokers. Definitely you might be able to get some discount there. Your occupational profile will also affect your premium rates, just in case you have been rated as dark blue or light blue. And finally, your working hours. If you have reduced your working hours, then that might translate to lesser cover, which would also mean lesser premiums. Hopefully you've picked up some good tips there, and please remember where I had a caution sign on some of the slides. It means that be very, very wary if you're going to adopt that approach, because it might mean you won't get your cover that you're foregoing. So make sure you speak to your financial advisor if you've got one, or otherwise do your research. All the tips I'm giving here are very general. Not all funds might even have those options, but if they do, they're worth exploring. So you'll need to check your PDS whether those options are available under your fund. Remember, this is not advice. I have never met you. I don't know what your circumstances are, but you have a choice. That's it for today. Hopefully you found this useful. If you did, please give it a thumbs up, and I hope we'll connect again in the next video.